Assalamu alaikum viewers. We have already prepared the balance sheet from two phases. The first phase is when we make the structures of a corporation with the assets account, liabilities accounts, and owner equity account. Then we add some more transaction relating to the income and expense account. So we incorporate these in the second phase. We have already prepared the balance sheet by these accounts, incorporating both phases, the phases 1 and phases 2. Yet the balance sheet is not 100% up to mark because we didn't add the adjusting entries so far. So, what are the adjusting entries and why do we need to record these adjusting entries? This is what we are going to learn in this lecture. I am Dr. Safdar Husain Tahir, Associate Professor, Lalpur Business School, Government College, University, Faisalabad. I did postdoc from UWA Business School, the University of Western Australia. So we understand what are the adjusting entries. This is the lecture number 5th, and we are try to understand the adjusting entries. Adjusting entries are not the error. These entries are important for completing the accounting cycle. The first one is recorded prepaid expenses, and then a recorded unearned revenue, and then unrecorded expense, and then unrecorded revenue. So we are going to adjust these entries because the adjustment is important because the 2024 is a separate year from 2025. We are preparing the financial statements of 2024, not of 2025. So the overlapping period is need to be adjusted. On December 16th, we have paid 40,000 shop rent via bank for 1 month starting from December 16. On December 31st, half of the month has gone and half of the rupees of 40,000 expired and becomes rent expense. Now we generalize these entries into rent expense to prepaid rent. Certainly, on December 31st, you received Pak rupees 15,000 from XYZ company as an advance payment for the use of delivery van in January. This is the advance payment. This is, you can say, is not your revenue. This is your liability. This is called unearned revenue. However, this transaction is not yet been recorded. We record this transaction in adjusting entries. The cash increase, that is debited 50,000 of 15,000, and unearned revenue, which is actually the liability of the company to give this service. The third entry is on December 2024, you incurred a maintenance expense of rupees 10,000 for the delivery van, which has yet not been recorded. The expense has not been incurred but not recorded. So maintenance expense 10,000, that is debited, and account payable, that is credited. Similarly, in December 24, you rendered service to Azim Foundation worth 50,000, which is yet not been recorded. Recorded account receivable. This is your account receivable. You paid the services and yet it becomes your account receivable. Account receivable of 50,000 and consultancy revenue of 50,000. In this way, you post these entries there individual account, which is a ledger. The 30,000 we post here, and the all account remain same, other than this one, and some of the account may change. Yes, this one. Again, the prepaid rent have a 40,000. Now it credited 20,000 rupees on 31st of December. Again, advertisement expense. This is the close into income statement, and salaries expense. This is a close into income statement, close into owner equity, rent expense close into owner equity, and unearned revenue generated on new account, that is 31st and 2024. Again, the maintenance expense, that is 10,000, and again that the account receivables and consultancy revenue generated account is there. So in this way, the trial balance will become this. After posting the adjusting entries, the trial balance increase. The debit balance is 41 lakh 25,000, 41 lakh and 25,000, and then you prepare the income statement again, because these entries are not incorporated in the income statement, in the previous income statement. Certainly there is a maintenance expense, and now the income is net profit is 1 lakh and 50,000. You have a consultancy revenue, you have a sale revenue, consultancy revenue, total revenue is this, cost of goods sold this, gross profit is this, rent expense, advertisement, salaries and maintenance expense are this, total operating expenses is this, and now the net profit, which was 1 lakh and 30,000, I think it increased 1 lakh and 50,000, and again you make the statement of owner equity, and the new capital is 21 lakh and 20,000. Again you make the balance sheet. This balance sheet is the true picture of the firm, because we have already adjusted the entries that are called the adjusting entries. So adjusting entries are added, structure is added, all income entries are added. This is the true picture of your corporation. What we are actually going to do is to prepare the financial statement. The basic financial statements are balance sheet number 1, income statement number 2, and cash flow statement is the number 3. The basic purpose of the financial accountant to depict the true picture of financial statement. Thank you so much.